traders at UBA say they expect the pressure on the naira to drop in the short term as the central bank is still committed to its weekly Forex sales to BDCs across the country, which is anticipated to inject more liquidity into the FX market. And following today's Treasury Bills Auction, Dumebi Udegbunam, a fixed income trader at UBA, joins me for a midweek review of events at Nigeria's fixed income and FX market. Maybe thank you for joining us today. Let's get right to it. You've taken a rather optimistic view of the outlook for the naira in the short term, and we know that majority of our earnings is tied to the movement of oil prices at the international market. To help us understand your perspective.
Good afternoon. Thank you for having me. So basically, the oil market as of today's trading is at 39.6, lower from its previous 41. A lot of traders in the market don't think it will break the $42 per barrel resistance level right now. So basically, yes, in terms of our foreign earnings, it's going to dampen going forward, which might in turn affect our foreign results. We have a reduction in capital inflow, and due to this recurrence of the second wave of the coronavirus, it might further drop again because a lot of countries are entering a second wave of lockdown, which in turn would affect the economics of these different countries. And also the IMF has further reduced the outlook of oil demand going forward. So basically, we are going to be affected by this, and we foresee further drop in our foreign reserves.
If we do see that further drop in our FX reserves, is this going to impact on the amount the CBN can continue to supply at the Bureau de change market?
Yes, most. If you notice, upon the resumption, they reduced from 5 days a week to once, from about $100,000 weekly to about 20. So they're trying their best to more or less manage, or should I use the word, sustain the currency at a particular level. So yes, it might further lead to a further reduction. But however, our equities market seem to be doing quite well. We've seen about a 0.3% increase. So we might still see further inflows, but not as rampant or large as we've seen in previous years. So it might be hedged by our foreign inflows coming into the stock market.
Okay, finally on the naira, what is your outlook for the trading band for the naira in the short to medium term?
And we expect a stable naira, in fact, to even close the year. We expect it to trade around these levels from now to probably to close the year. And we expect such activities to be supported by the CBN. CBN has done a wonderful job in trying to sustain and more or less provide effects to the industry. So we might not see a 500 levels, $500 to 1 naira, 500 naira to $1 in the parallel market. We might not see that anytime soon. However, right now we're facing a very big issue, which is economic sustenance instead of recovery. So right now, what the CBN is focused on is how to sustain the economy and also how to sustain a very stable naira.
Okay, let's move on to the fixed income market. The Debt Management Office offered 130.6 billion at today's NTB market. I understand that there's strong demand, especially for the 1-year paper. Could you just help us understand the trend that we've seen in the last 2 weeks?
So basically, in general, the Treasury Bills market has seen a drop in yields. We're close to sub-1 levels. This is the lowest we've seen in the last 5 years. We've seen rates go as low as currently today 0.4 on the 91 day, 0.5 on 182 day, and 0.7 on 264 day bill. Basically, reason being, there's a lot of liquidity right now in the system. Our industry figure system liquidity is about 700 billion. So we are going into a very, very low rates, low yield territory right now in the market, and we expect to see rates go further down. In the month of November and December, we'll have about 3.5 trillion naira maturing in both OMO and NTB bills, which will further drop rates down. We have a coupon payment of about 90 billion, which is the last coupon payment for the year coming in October. So we expect to see rates go further down in the bonds market. To see rates go as low as 7.1 in the 2050, which opened at 9.6 when it was first issued. So this is a very big worry. However, it's good for us because the government is actually borrowing at a very lower cost, because as when the figures that came out, our debt to GDP ratio or our deficit lies about 13 trillion, which is not good for a country like Nigeria.
So are you saying that especially for the long end of the curve, we may not even see a resistance on the part of investors, because we keep having that conversation about how low rates can go, and at what point investors will say, no, we demand more to hold on to this securities?
So the last time we said this was like, was it going to break 10? It broke 10, it got to 9. Was it going to break 9? It broke 9, it got to 8. Was it going to break 8? It broke 8 and got to 6. So right now we don't know where it's going to cap, where it's going to be the next minimum. Right now we are seeing markets go towards 6.56 as our close of business today. So will it break 4? I doubt. So let's cap it at 4 levels at the long end, let's say 2050.
Okay, now you mentioned the government finances in terms of borrowing. We're seeing, we know that we still have high debt levels, and of course the debt service, despite the low rates we've seen, continues to climb. And looking at the debt service versus, ratio versus debt service to government revenue, I'm just wondering what your thoughts are in terms of how the government is going to manage this going forward.
If you notice right now, I think the DMO is basically focused on making or watching the cost of borrowing, which is why you've seen a lot of rates have gone down. So basically, that carefully watching that, at the same time watching the revenue. How much can we generate enough to surpass or help cushion our deficits, and how much we can cut our costs. So basically, so the main focus on the GMO right now is our cost of borrowing, which they've tried and they've done a wonderful job doing this low yielding territory to take advantage of. When the 2050 bond was first issued, it was at 12 levels. Right now we are seeing at 7. And right now they further reduced the auction numbers to 30 billion monthly to close the year. So basically, we do not see rates going further up, which in turn would help watch or observe our cost of borrowing.